Today's Talking Point. I'm your host, Neeraj Shah, and it's a special show today because we've got the Citi think tank with us to tell us what they made of earnings overall, as well as for some of the key sectors that each of these gentlemen individually track. Gentlemen, all of you, thank you so much for taking the time out and joining us in our studios. It's a pleasure talking to you today. Surendra, let me start with you. It was anticipated that Q2 would be a strong quarter, which will lend itself to a strong first half. To your mind, did it live up to the billing?
Yeah, good morning, Neeraj. Thanks for having all of us on the show. So, see, from a quarter perspective, I would say the answer is yes. Okay, because of, I would say two things here. Firstly, if you look at BSC 100, right, the EBITDA growth, and if you even exclude energy, which can be a bit volatile, the growth was closer to 20% year over year, which is pretty strong. Earnings are like closer upwards of 35%, 25%, sorry. So clearly a good quarter. And the second thing which we always look at is in India, historically, over the last decade, in most of the years, we have started with high expectations, and then there is always a risk of downward revisions as we go through the year. Right now, we are in a territory where we are not seeing downward revisions. Okay, and the high earnings growth that people started with in the year is kind of holding up. So on both those counts, I think it clearly met expectations. So to that extent, a good quarter and fairly well-rounded as well in terms of sectoral performance. So overall, it did feel like a decent quarter.
So you look at overall strategy, looking at heading research of your esteemed colleagues sitting here. Which of these pockets, Surendra, including IT and otherwise, stood out the most for you in terms of either meeting earnings because the expectations are high, or maybe beating earnings relative to what the estimates were?
Yeah, so in fact, like maybe I'll talk about some of these sectors first, right? Like private sector lenders. Very good NII growth in excess of 20% for the entire group. And again, Kunal will talk more about it. Similarly, in autos, expectations have been high because the last few quarters have been strong. And again, those expectations were met. Industrials was one of the better performing categories. And again, Atul covers it. And even as we go into FY25, our expectations are that some of these sectors like industrials, for example, will be one of the big drivers for overall earnings. So the strength, as I said, was pretty much across the board. There were a couple of like sectors where things are a little weak, partly because of global reasons or any other specific reason. But in general, sectoral performance was pretty decent this quarter.
Yeah, and you know the space that Arvind tracks, autos has a fabulous run as well. So it'll be lovely to talk and get some insights there too. But we'll start off with the big boy, which is from a weightage perspective, which is banks, and then I'll come to you on IT as well. But yeah, you know, BFSI, the lending financials, always a dichotomy, more so because of the moves that happened beyond the earnings. Sure. As we've seen recently on Thursday and Friday too. But what did you make of the numbers? And then I'll come to the other noise points.
Sure. So when we look at 2Q, as Surendra was highlighting, NII growth was 20%. Operating profit growth was also 20-odd%. And earnings growth were more than 25%. On an aggregate basis for all the private lenders, we saw a beat of almost 5 to 6-odd% to our estimate. So even though NIMs were something which were very closely tracked, but there was a surprise which has come in with respect to the credit cost as well as the fee income, and that's where we saw the earnings bit coming in. In terms of the revisions, if you look at it post the quarter, in fact, in most of the places there was upward revision of 1 or 2-odd%. In one of the large cap names, ICICI, we had revised it by 5 to 6-odd% because of the credit cost. But there were hardly any earnings downgrade which have happened post Q2 with the private lenders. So I would say overall 5-6% beat to our estimate and leading to some earnings upgrade.
Got it. I saw your notes, all right, and justifiably so, but it is in line with what almost everybody else is also saying, that when you look at what an analyst would like from a 12-month, 24-month perspective, it is the private banks, the HDFC banks of the world, which top the list. Somehow, Kunal, we're not seeing that in the price performance at all, and it's not just a one-quarter phenomenon, right? So what would it take beyond earnings for there to be some zing into stock price performance, part one? And part two, can there be an earnings surprise into any of these, considering the fact that we may be looking at a year of earning interest rate cuts, presumably in the second half, maybe there might be a surprise and we might see in the first half of the next calendar too.
True. So when you look at it in terms of the stock performance and where we had seen the underperformance coming through, that's largely because of the trajectory of the return on asset and return on equity. So it seems like when margins were at its peak level in 4Q, it almost like ROAs have also peaked. To that extent, even sustaining the ROAs would be critical. People expected, the entire street was expecting the margin moderation to a much higher extent. When we look at it, maybe till Q2 or maybe in the first half, there has been margin moderation across the banks, but at the NII level, there has not been the disappointment yet. So if we see the consistency in the earnings all through, and if ROAs remain stable, I think people are just looking forward to it, because everyone thinks that getting into 4Q, the base of last year's Q4 was very high, and then you will see a major moderation coming through in terms of the operating profit and the earnings growth. If there is the beat on those numbers, that's where we will actually start seeing the stock performance as well coming through. As you highlighted with respect to HDFC Bank, there was an event which was there in terms of the merger, and it was a big event. There were integration costs which was much higher than what entire street was anticipating. So we didn't expect it to do much better. Okay, but just a couple of weeks back, we have now included that into our top pick. So maybe we were also not very positive on the name, but now we think that it should start outperforming, given that it has underperformed Bank Nifty by almost 10 odd percent, be it 6 months, 12 months, and it has underperformed Nifty by almost 14 to 15 odd percent. Now, maybe in terms of the ROAs, given that it has entirely got rebased, there should be an improvement quarter over quarter, and you should start seeing outperformance. And that's where HDFC Bank is now included in our top picks.
Okay, well, if you didn't have it earlier and you have it now, then your call was spot on, Kunal. So great calling there. By the way, viewers, standard disclaimer, none of the stocks that are discussed here are recommendations. There may be recommendations from the Citi team for their institutional clients, not for viewers. If you want, rather, I would urge that please consult your advisors before you try and act upon any of the advice on this show or any other show out here at BQ Prime or any other media platform as well. Now, that was, of course, Kunal Shah, research analyst, Indian banks and financials at Citi Research. Arvind, Sharma, he's analyst of Indian autos and transportation at Citi. Arvind, autos have had a fairly decent run, if you will, since the, let's say from Jan 2022 selectively, if you look at it, there has been a bit of an uptick that has come into that pocket. What did you make of earnings for the second quarter and the first half? And does that leave for any rooms for surprises into any of the individual pockets for the second half?
Sure, Neeraj. So in autos, we get to know the volumes upfront on a monthly basis. So the surprises in the earnings primarily come from how the companies have managed the cost part.
Right.
A lot of it is driven by commodities. In almost all the companies that reported, they reported better gross margins than expected, partly aided by commodity costs. And I believe also the companies have been very conscious of how they are managing the other costs, including advertising, marketing, other fixed costs. And the pricing has been also good. Second part which has helped the margins is the mix. So what you've seen, say in car companies, the higher end SUV selling more than the lower end cars. So the mix adds to the margins. Similarly in bikes also, slightly higher end bikes selling more. Again, the mix adds to the margins. So I believe those two were the key factors why earnings and margins were better than expectations this quarter. Since it was the festive quarter, almost every management talked about the expectation from the festive season. Almost mid-teens kind of expectations in terms of YOY, adjusting for the difference in the calendar year versus the festive year. Some of the companies have reported festive retails, and they are broadly in line, 15 to 20% kind of a volume growth. So I believe the demand till now has held on. The thing is that even before the festive season, because companies were expecting decent volume, there was a bit of an inventory buildup. Now, what will happen in third quarter is how do the demand sustain beyond the festive season? That will decide the inventory, how do you liquidate inventory? Because this is also the last month of the model year. Dealers tend to liquidate inventory of the old year. So I think that is what will decide how the wholesale dispatches happen in the third quarter. Second quarter was good, commodity costs and good demand. Third quarter would be all about the sustainability of this demand and how the companies manage inventory. In terms of cost pressures, I think it would probably remain benign. We don't expect an escalations. There could be a few discounting, partly because there's high competition, partly because it's year end. So year end tends to be slightly on the discount side. But I think we don't expect a big negative surprise in terms of the cost pressures or the margins.
Okay.
The only other aspect and slightly on the negative side is on the exports front, on the global markets. Some of the Indian OEMs as well as the part makers have got key proportion of their revenue coming from export market, where it's been slightly on the wobbly side. That we will need to see how it all pans out. But on the domestic front, we think demand should stay on.
Great. Just one quick word. I mean, do you reckon that there could be a better acceptance of the growth come valuations of two-wheeler companies now versus maybe 6 to 9 months ago? Because they've kind of faced this narrative of heightened competition from the electric two-wheelers, and that's why I presume that's why the valuations have been kept under a lid. But the growth has been, let's say, sanguine. If I look at the recent data, can it build upon it? Can two-wheelers come back into favor?
I think two-wheelers over last maybe couple of quarters have slightly come on better. It's also because of the base last year, which was fiscal 23. You had a big discrepancy between two-wheelers and passenger vehicle growth. So this time it's also a bit of a base catching on. But you're right, EVs is an important thing. Most of the legacy players have EVs in their portfolio, but how it pans out, how does the competitive intensity pan out? This is the last year of FAME 2 incentive. Going into March, the incentive that we know as of now will no longer be there. Is it modified? Is it extinguished? We still don't know. So I think on the EV side, since you are asking, a lot will depend on how the overall regulatory and the demand environment pans out. But overall, two-wheelers, yes, it has been better than expected. As we said, some of the festive retail numbers have been better than expected. But there again, the competition is pretty intense, especially in the higher-end motorcycle segment, where we've seen a slew of new launches from some of the global iconic brands. I think that segment still has a very high competition. In the entry-level segment, it will depend on how that demand pans out, festive demand, rural demand, and that will decide the entry-level segment in two-wheelers.
So, be your constructive two-wheelers, I presume.
So, out of the 4 two-wheeler stocks that we cover, we are positive on 2 and negative on 2. So we are kind of mixed in the two-wheeler.
Which are the 2 that you're positive on? Sorry, if I ask.
So we have buys on Eicher Motors and Hero MotoCorp.
Okay, fair call. Okay, now before I come to Surendra on IT, bring in Atul into this conversation, because some of the very important pockets and some which have a slightly long-term potential because of the government moves as well. Atul, take your pick. What should we start with? Industrials?
Yeah.
Okay, so what did you make of the quarter, and what are the anomalies that you spotted? Because it's a very diverse sector, some getting a lot of orders, some seeing some cost pressures. What stood out for you?
Yeah, so see, the biggest standout for me was obviously L&T's result, where we saw extremely strong order inflow growth, and it's obviously a bellwether stock in the sector. And the key point there, in my view, was that while government capex in India has been very strong, has been on an uptrend, and companies like L&T, have benefited from it, and many others as well. But now it looks like that the capex in the Middle East has been doing probably better than what most people have thought. And in terms of the capability and the skill set, L&T has kind of ramped itself up to the next level. And we are seeing very strong order inflows there as well. So I thought that this positive surprise adds to an already existing very strong domestic theme. And looking at the dynamics, the capex in India should continue for next several years, but this Middle Eastern capex can also continue.
And despite this current conflict, clouds of conflict.
So most of it is happening in Saudi Arabia,
Isolated.
which is very stable at this point of time, and we do not sense much impact as of now, because the conflict is limited to one part of Middle East, and it does not impact the larger, more stable country. So obviously oil prices are a bit of a variable there, but as long as they remain within certain range, that capex should happen. And so I think that was one big positive standout. In terms of some of the data points which need to be watched out for, in some of the companies levered to private capex, we did see some moderation here and there, but it's a bit of a blip. Maybe people are becoming a little cautious in run up to the election and not taking very aggressive call of capacity expansion. Plus, we also need to keep in mind that post-COVID, a lot of ordering has already happened because people were not able to order out for a couple of years, and then the demand came back. So some of that catch-up, probably has happened. So that was a bit of a, I won't say negative surprise, but something to watch out for, going ahead.
Okay, and just wondering where do these stocks stack up in terms of the argument of valuations versus the earnings growth potential, or the certainty of growth that they bring to the table? Because some of these are priced to perfection now for a while. So many calls of how they are looking expensive, and they continue to remain expensive.
So see, the answer to the second part is very simple, that the earnings growth visibility remains very high, and the reason is that you have order books in most cases which are at multi-year highs, large cap, mid caps, small cap. So that gives you, earnings growth visibility. In terms of the trading multiple, if you see, yes, most of these stocks will be probably trading at the higher end of 5-year, 7-year, 8-year band. But now the cycle is looking up, and earnings are getting delivered, and we have seen that in face of very strong medium-term earnings growth, the multiples can sustain. So that is the call we are taking across this space, that because earnings growth visibility is quite high over 3, 4, 5-year period, the multiples should sustain, even though, in a historical perspective, they are at the higher end.
Okay, so I guess from the answer, I'm guessing that Larsen and Toubro would be amongst the favorites out there. What else constitutes the list, if you will?
So we are also very positive on the defense theme.
Okay.
So Bharat Electronics is our topic in that part of the universe, because again, we think that it's a multi-year theme driven by government policy, and they are actually, at least in the absolute terms, the multiples are also not that expensive, 25 times P. Many other parts of the industrial universe, as you would know, are trading at much higher multiples. And the revenue can grow at 15-16% for next several years. It's a high ROE business. So that name, we are quite positive. And from a slightly medium-term perspective, we are also very positive on the largest port company in India, Adani Port. There are obviously, over past 6-7 months, there have been news flow around the group, etc. But we think that we are toward the fag end of the negative news cycle. Business is doing well, balance sheet is good, and the valuation multiples there actually are quite attractive in our view.
Got it. Viewers, again, standard disclaimer, Adani Group owns Quintillion Business Media, which owns BQ Prime, and Quintillion Business Media. The Adani Media Group has taken a controlling stake or a complete stake in Quintillion Business Media as well. So that's to be taken on board. Surendra, this argument of stocks which are showing growth and trading at high multiples versus some which are not able to, has seen an interesting move, right? The last 12 months, we've seen banks, as Kunal was saying, some of these banks, traditionally high growth banks, haven't quite grown as well and have seen the multiples derate. HDFC Bank, Kotak Bank, for example, but a whole host of broader end of the spectrum sectors, EMS companies, some of the defense plays, some of the cap good plays, are all trading at premium valuations and continue to do that. Now, what's happening here? Is money chasing high growth?
So yeah, I think, see, there are a few things in play. Firstly, it's been a very strong market from a flow perspective, right? If you look at calendar year to date, the mutual funds have deployed around $17-18 billion into the market. Foreign investors have deployed around $12 billion, and then retail ownership of the market has also gone up. So it's a good flow environment, and typically in this kind of an environment, investors always chase visibility, right? And I think what is important here is the medium-term visibility, because banks, if you look at it, right, while some of them, like some specific names you mentioned, may have not surprised, but there are a number of others who have had great numbers, right? But in general, in banks, there has been some concern or the other since March, April, right? Earlier around margins, now around certain segments of their business and so on, right? And markets like medium-term visibility, and like, for example, Atul mentioned on defense, right? It's a very straightforward theme. I think that 14, 15, 16% kind of a growth potential is there. And to that extent, people are buying into that story. Okay, next 3-5 years, this kind of a compounding is possible. So there have been a number of pockets in the market where that compounding is visible with relatively lower risks. Okay, at least as we stand today.
Sure.
And those segments are really getting re-rated. And the second thing which is also important is the ownership level, right? So for example, banks among foreign investors are already heavily overowned, right? Significantly above the benchmark weight. So that also plays a role, particularly when the big buyers are on the domestic side. And foreigners, at least say in the first quarter, and again recently they have been sellers. So I think all those dynamics are at play. But again, if you go back even in the last decade, right, you will see for a number of years it was consumer staples which was doing well, and valuations kept on going up. Paints, right, jewelry, all those segments. And then even retail banks had a great run. So I think the market is always focused on medium-term visibility, and I don't think it's any different. It's just that flows have been very strong, amplifying the impact in the last few months.
So the tape is against banks because they are foreign owned and there's a lot of supply there. I presume it is in favor of, you think, pockets like defense and a few others. What are the favorites?
Yeah. So definitely that is one reason. Okay, I think in addition to the medium-term growth potential, without visible risks, right? In banks, for example, unsecured lending, market has been worried. Prior to that, margins, even today, right? People are worried. So banks have had pockets or some certain concerns. Right? If you think about defense or a lot of those sectors, right? You feel like, yeah, there is a runway to growth. Next 3-5 years, you just can't see a challenge. Beyond maybe a temporary thing, there could be some lack of ordering or slowness in ordering around particular events and so on. But I don't think medium term there are concerns. So that plus the flow argument which you just mentioned, and industrials has been one of those pockets. If you look at FII inflows into the country in the last few quarters, industrials is one of those sectors which has seen very good inflows. Autos has seen very good inflows, and some of those sectors have done well.
You two must be very busy, man, with your clients, I'm presuming. But, Surendra mentioned this issue, so I'll rake it up before I come to IT, the unsecured lending. Now, how big a setback is it, or is it, what do you say, priced in, if you will, because these days markets tend to price in everything in less than 24 hours?
So there have been the early delinquencies which are coming up in some pockets, but that's also restricted to very low ticket personal loans as such. Some action from RBI was expected after maybe in the monetary policy, they indicated all the banks to safeguard their interest with respect to unsecured lending, and we saw risk weights being raised by 25 percentage points, both on unsecured lending as well as banks lending to NBFCs. So when we put those maybe on the regulatory side, whatever has to be done, that was already done, it's factored into the markets. In terms of the overall unsecured lending, when we look at it, we did a deep dive into this entire segment almost a month back, and we had seen that there were few players who have been aggressive in unsecured lending with a relatively still on a much higher ticket size, which is not giving pain at this point in time. When you look at most of the other private banks, there has been the increase, but they still give it out to their existing customers, and they have the deposit accounts with them wherein they are able to track the behavior pretty well. They have the analytics around it. So private banks are not seeing that kind of an issue with respect to unsecured lending at this point in time.
Got it. Okay, Surendra, the other big wig, IT. Is there anything that was a positive out of the delivery or the commentary? I know one can argue that at some point of time valuations will be in favor, if not already, margins might reach a trough. But what about Q1 and Q2 in particular? Was there anything that stood out positively?
So see, the only positive, the way we look at it, has been in terms of the cost side, where I think companies have been very proactive about managing costs, right? So I think partly the headcount reduction has come in more than what the street was anticipating, or like higher reduction. That's one. And even discretionary costs, if you look at the numbers, like costs like travel, etc., have been significantly better controlled than what people would have thought. So if you look at a lot of companies this quarter, the revenue was in line, in some cases a miss, but the costs were well controlled, and which is why on the EBIT side, numbers were broadly in line with expectations. So I would say it's a lot to do with the cost side, which has been more resilient than what people thought. But the revenue numbers are still quite challenging, and what we worry about is more the forward-looking indicators, right? If you look at the order flow, for example, and again, certain companies have good order flow, but I think you have to kind of layer the fact that right now there are more multi-year deals in the market, because these are cost takeout deals which are typically 5, 6, 7 years versus 1 year back where a bulk of the discretionary deals were 6 months, 12 months, 18 months, right? So you have to layer that together. The headcount, which is in some ways kind of shows how confident management is on growth, on a YOY basis is flat, down, marginally up for somewhere in that range. So everything, and like then we have our own Citi CIO survey globally, where we survey 100 plus CIOs, which is also suggesting only a very modest recovery globally for tech spending. And then finally, S&P revenue growth, S&P 500 revenue growth usually has been a decent indicator for the outlook for Indian IT. That's also suggesting a fairly muted kind of a picture. So everything that we look at from a forward-looking perspective is still showing challenges. And then on top of that, we also have to keep in mind that a lot of large enterprises are growing their captives in India. That's been a big theme in the last couple of years. You hear a lot more press on it because a lot more clients for these companies, which are like Fortune 2000 companies, are opening and growing their own centers. So I think a combination of that does make the sector challenging from a fundamental perspective. Now on valuations, I think it's honestly a big debate. I think a lot of investors are looking at it and saying that, okay, in the last 21 months or 22 months, the sector has underperformed the market by 30% or so. Okay, so it's not so bad. While the other side, you can look at it and say on a 1 year forward basis, the sector trades at 23, 24 times. And the pre-COVID 3-4 year average was more like 18 times. So I think you can debate it, but we think that usually, like based on what we have seen in the past, growth is what determines valuations for IT services stocks. And that outlook is still quite muted. If you look at this calendar year, the US economy has actually held up pretty nicely. And despite that, Indian IT has been challenged. And there seems to be more uncertainty on the US macro as we go into next year. Right? So to that extent, the revenue side could still be pretty challenged. And that usually is the key determinant for IT stocks. And that is the reason we are still underweight on the sector.
Okay, so if IT at large is underweight, what about a specific vertical? I mean, ER&D, I mean, KPIT trades at what, 75, 80 times, but they've upped the growth to 37. LTTS, while it reduced the guidance, but said that they still hope they'll do the upper end. Is this pocket looking constructive, or are the valuations baking that in?
Sure. So again, we don't cover one of the names you spoke about, so I'll kind of restrict it to the sector. Okay, so see, autos is one of those segments which has held up very nicely for everybody. Okay, and the simple reason being that if you are an auto company today, a traditional auto company, there is no choice but to go ahead with your EV plans irrespective of the macro, because it's a question of survival, right? And if you are a new player, then obviously you spend because you are going to challenge the incumbents, right? So auto spending has been strong across the board. Now it depends on what your exposure to autos is.
Sure.
Right? Somebody with 100% exposure is obviously doing very well. Somebody with 20-25% exposure is doing okay, and somebody who doesn't have an exposure is challenged.
Sure.
Because everything else is generally muted, right? There are some companies which can buck the trend with some deal wins here and there. That's different. But even in the ER&D space, you are seeing the same trends, right? You look at the major companies, you see very divergent trends, and a lot of it is actually coming in because of the exposure to autos.
Sure.
Okay, and like some of these names, like LTTS, for example, we cover. Now, again, they're doing well, but the fact is that they had to revise their guidance down. Okay, the organic growth is still single digit percentage, and valuations in that context at 30 plus times are definitely not cheap.
Got it. Okay, great. Okay, just before we wrap the show, I would have quick 2 questions to both of you, because there are certain pockets which you cover which you haven't gotten a chance to talk about. So, I've spoken about two-wheelers with you. What about the other pack? You gave a brief overview of what the thing looks like. Surendra out here mentions that autos seem to be in a fine fettle globally, in some pockets at least, locally as well, despite what's happened to the UAW strike, etc. What stands out as a clear favorite? What is a clear avoid within the whole bucket?
Sure. So in terms of a clear favorite as a top pick, we have Maruti. Why? Because so in Indian auto, that is domestic part, we are seeing this big shift towards premium SUVs from small cars. And this is where self-help story. This company almost had very low presence in SUVs just a year or 14 months back. But the way the mix shift has happened, that helps in volumes. That gives them a bit of a competitive edge. And it's also translating into margins like we've seen. So that's where we see that self-help story playing out clearly. Going forward, naturally, small cars are also important. We can't say because they add to the volumes, but this mix shift is something which is a very salient trend happening in the passenger vehicle space as a whole in India. And we like this company because the delta is a lot. That's one part. On this, where we would be cautious or a bit of uncertainty is on rural demand. We just had some worries on the tractors front, so that might be a bit of an impediment. But that again we don't know because it's it has to pan out. What's the impact of monsoons finally in third quarter? How does the weather change in the next quarter, which is January? Hopefully, no unseasonal rains. Those kind of things are more uncertain. But this clear shift to bigger SUVs and a self-help story for Maruti clearly helps it.
Pretty interesting, and how they've actually come up with the market share curve as well, despite not being there, not being present for, a couple of years ago. It's been quite stunning, really. Thanks for that. Now, two very interesting sectors. I don't know which one to choose as the last question on the show. Power, property, both of them seem to be in a really good space. You pick one and tell me what is it that looks very worth talking about.
So power, we have been very positive because, over past 18 months or so, we have had this view that India is going to face increasing episodes of peak power deficits. While base power is fine, but peak power deficits, will keep increasing in part because what is happening in the economy, power demand growth has been healthy. And that will, lead to creation of more thermal, coal-based, power capacity. And on that theme, NTPC has been our top pick for quite some time, and we think that here the growth visibility is improving very substantially over medium term. We have already seen, it's a restart of ordering, by NTPC after a gap of several years, and we think that we are still in the, first half or probably first, very early part of this process, and it will go on for several years. So we think that it's a very, strong theme and will be there for a few years at least.
Wow. And I presume that would extend very quickly to power ancillaries as well, because they are in a bit of a frenzy at multiple levels.
So that is one factor driving it, but the other is obviously the reforms which are happening in the sector, and the discoms are being made to order various power equipment, smart meters, transformers, rectifiers,
Exactly.
a whole host of stuff. Yes,
got it. Okay, Atul, Arvind, Kunal, Surendra, thank you so much, all of you, for joining us today on the show and giving us your thoughts. Pleasure talking to you today.
Thank you.
Thank you.
Yeah. And viewers, thanks for tuning into this very special conversation with Citi Research.